This is Efrem Hoffman broadcasting live from NakedSwanTrading.com on June the 11th, 2012 at 3:29 p.m. I'd like to start off with the full disclaimer. Actually, the full disclaimer is on our website under NakedSwanTrading.com/full-disclaimer. And as you see on the screen here. So before you listen to anything I have to say or read anything on our website, please understand what the disclaimer is and what the risks are to trading. As all of you know, there is no guarantees in trading. This is certainly not a solicitation to buy or sell securities or a recommendation of any kind. So please read the full disclaimer before acting. Now I'd like to go on to discuss the market update for this week and what to look for going forward. Just before I get into that, for any new viewers, I'd like you to take notice at the top of our website. You could just type your name in and your email, and you will receive free live market briefings as they're posted, as well as from time to time there'll be free live webinar briefings where you could actually participate and ask questions. So I highly encourage everyone who hasn't yet signed up to do so. Also, I'd like to make notice that there was an article recently in Traders World magazine discussing the details and the applicability of this unique trading approach that could be helpful for risk management and identifying opportunities in an uncertain world. We've recently also, on May the 18th, issued a crash warning for the stock market, and that is to identify that any rallies that take place during the course of this summer and throughout the year are nothing but dead cat bounces or short covering rallies that will fail and ultimately lead to much lower lows as we progress through the year and especially into February and May of next year. That does not mean that there won't be episodes of crisis much sooner. And we will be identifying those specific hot zones on our weekly updates. Another reason that I would recommend, or at least encourage people, to sign up and get these briefings. But be sure to read the full disclaimer before acting on the information. Now, I'm going to take you to a risk map. At Naked Swan Trading, we call it a high-definition risk map because it outlines what different traders on different time frames are going to be perceiving in terms of changes in momentum of price and its impact on future volatility. If you could get both of those things right, momentum and volatility, ahead of the crowd, you could really establish high probability opportunities, both for preserving capital and for promoting active trades. So the actual risk map that you're seeing in front of you right now is a risk map of the NASDAQ 100. Okay, so that would be a map that would help traders try to identify some key turning points that could impact the exchange traded fund that's often traded, which is the QQQs. Okay. The reason why I'm showing the index is because, number one, there's more history on the index, and number two, it's harder to influence an index since it's not something that's tradable. So I like looking at the index to give me the idea of where a broad trend is taking place. I also look at the ETFs, and to marry the two and see where there's some discrepancies between what the index is saying and what the actual tradable ETF is saying, and that could give insight. But right now, we'll focus on the index. So what is it showing? Well, it's showing kind of exactly what we've been anticipating over the past number of months. We have this red risk window that extends well into next year. It actually goes beyond the March period. The first wave is really into February and then kind of goes, extends as far as May of next year. But as you can see here, the upper tier of this risk window, we got awfully close to that upper tier on this short covering rally. Now, there's been a few rallies that have taken place as of late. We had that fear sell-off, and as would be expected in any kind of fear sell-off, you're going to need to build root cause, or as I put it, energy, in order to get the next leg down. And if this happened to be an uptrend, the next leg up. You need some form of a retracement in order to trick enough people into thinking that the trend is over, so that when the trend reignites again, those people rush back in to the direction of the trend and try to preserve their wealth by actually getting out of positions that aren't working for them. And in this case, for example, this little rally that occurred on the 18th, okay, basically was failed. So basically, indicating on the 18th that we were in a crash warning, and we really indicated the idea that the market was going to accelerate down way back in the beginning of April, when we put out warnings, that Apple was going to be in trouble, in the April period, right near the highs, and right around the highs, the market, it rolled over and took everything down. Okay, the reason why a crash warning was put out on the 18th wasn't because we were waiting for the market to come down and give us some kind of confirmation that the market was going to break down. We already knew well back in March that the market was weakening and was going to have a pullback. But pullbacks, even of this magnitude, aren't a crash. A crash is something different. A crash is when the mentality of traders is such that every time that there is some kind of small rally, and regardless of what type of market sector it's in, you end up getting a cascade of selling on the downside across many industry groups at the same time, with rapid reduction in market liquidity, okay, and a toxic order flow in the order book that doesn't permit market makers to take on a lot of the informed traders that are trying to actually put orders in ahead of expected market moves. And what I'm seeing going forward is more of the same. Like, for example, this rally failed, and then we had another rally, and it's now starting to fail. And the thing is, the top of this risk box pretty much identifies the area where you would expect the market to fail. So it kind of got, a little bit more to the upper limits. I mean, really 2581 to 2607 on the NASDAQ 100 is, intense resistance, And, on a daily basis, we could run into there during the day, but at the end of the day, and when I say the end of the day, I don't mean the end of that day, but at the end of the day, meaning like within this risk box, if you hit that upper area, it's going to be harder and harder for the market to string together a rally. And ultimately what happens is that each time the market goes up and uses and expends energy and fails at a point, it becomes very discouraging to traders. And when the market starts moving the other way, it starts to accelerate along the direction of the main trend. So, a lot of traders are going to be eyeing this level, that 2415 level would be an important level. It is slightly below the lows, okay? But, getting underneath that level for more than a day, that would definitely open up an acceleration of trend. Now, the way naked swan trading works is we don't wait for the market to come down to say that we're in trouble. That's already too late. You want to act in advance of the market action. So that's why last week we were putting out alerts on Naked Swan Trader, which is our Twitter handle, okay? And it's also available on our website under nakedswantrading.com on the side, on the right side panel, okay, with the latest updates. And what we were basically saying is that this is nothing but a short covering rally. Don't get too excited. And part of the reason is that while the S&P and the NASDAQ may seem like they're large market indices with a lot of component stocks, there's still a very, very small segment of the overall market. And personally, I like tracking the Wilshire Total Market Index, TWM. I also like following even the more elaborate index, which happens to be the Dorchester Equity and Bond Index, which covers 80% of everything that trades pretty much in the United States. And it is showing very, very severe downside action as we continue to unfold through the summer, and especially right into next May. And we've got some key dates that we're going into. And the way we look at key dates is that we try to see how the market is acting into those critical risk windows, and if there's any sign of weakness in a downtrend, which we're in right now, or if we were in an uptrend, we'd look for signs of strength. Okay, and if there was any sign of strength, then basically, well, for example, in the downtrend, if there was any sign of weakness, we would expect that the market is going to roll over in earnest. And it's exactly kind of what's happening each time it's pushing up towards a wall of resistance. Okay, and you see this purple boundary over here, which is kind of hugging this teal boundary. Well, basically, this teal boundary, like all other boundaries, represent a balance point of zero momentum for the next higher time scale of traders. And every trader from a higher time scale or higher time horizon tends to put on more weight in their trades. So as a trend evolves, it starts to snowball, and it crystallizes the trend that makes it more obvious to the rest of the traders. We don't want to be one of those people that are hit by one of those snowballs of trading activity. We want to actually see a map that tells us how that snowball is going to be forming and growing over time, so that we could actually participate or at least stand on the sidelines and wait for better price levels and valuations to reach us. And you could see over here across the precipice of this 0-point line is another line from a higher time horizon. And if I zoom out over here, you're going to see the next big gap. You see over here, we move from one gap to the next gap, kind of like an electron in an orbit. Well, the next gap is at much, much lower. And that's why I'm talking about a crash developing, because a crash means that each time the market proceeds to new lows, it's accelerating its drama of activity at a point where it gets to a point where people at the end of the day see it as a very large magnitude move, and they classify it as a crash, but often when it's too late. Now, those events are often coined as black swan events. These events tend to be widely separated in time, but their impacts are great and often only seen in retrospect. We want to see them ahead of time, and you can do that if you overlay these zero momentum balance points for traders across different time horizons. And that's exactly what this risk map does, and it is the only risk map that is capable of doing that on the market today. And I'm very excited to let everyone know that's listening here that we actually have a product release that is going to be taking place over the next week or two, and we will update anyone that signs up to the Naked Swan trading site. At the top of the site, you sign up. As soon as the product becomes available, there will be special introductory evaluations of that service that will really be able to, that is designed to help traders really see the market for what it is, and not see black swan events as necessarily dangerous events, but events of opportunity, okay? And ones where, the profit opportunities or the risk management potential is open-ended. It's really a function of how well you're actually looking at the available information that normally isn't seen in the market. So right now what I'm seeing is 2581 to 2607 is the upper end of this risk window at this point, and the next major level down is the 2139 level. That is a huge next level. Now, yes, there are some levels in between here, like that 2449, but like I'm saying, once the market clears 2415 on a daily basis, trades underneath it for a whole day, that's when the acceleration will come in. But we don't need to really wait. We already know that we're at the upper end of this level. You should not be thinking about getting excited on the long side. You should be putting together a shopping cart of potential short opportunities, or using this as a field, a price field that tells you when to actually, take off risk from some of your trading or investment positions and then come back at a later time. Now, I do understand that buy and hold traders say, well, you can't time the market, and if you get out, you're never going to get back in. But that's the whole idea of a risk window. It tells you when the risk has subsided. Just like Newton said, for every cause, there is an effect. It's the same thing in the market. Now, the causes may be very complex and interrelated, but when they do unfold like dominoes, okay, and the pins start getting knocked down, okay, there does come a time when all the pins are knocked down, and that's the end of the event. That doesn't mean that other news events can't come in and keep on, banging price near the lows. But it does mean that the majority of the risk has been squeezed out of the market. And all that you could ask for is trying to identify those pockets in the market where you could actually try to stay clear of trouble. And we are definitely entering at least from the perspective of the risk map, a period of trouble between the June period and May of next year. And it will be coalescing in waves. And the first wave of activity, the earliest wave of activity upcoming is, the earliest would be, starting into, it's kind of starting a little bit today, but kind of going, starting to accelerate maybe around the 13th. If it doesn't, then there's a lot of other areas that start accelerating, their activity into starting around the 20th, 21st into the 26th of June. And then there's so many other dates that are very, very close together. There's some on July the 3rd and then July the 18th through the end of July and then into August the 3rd. There's many more during the year, but I think let's just talk about the near-term ones. But time itself is very critical, but also to understand where time intersects price is equally critical, and probably even more critical because you've got a confluence of events. And you can see here, we got a confluence of events in the sense that price was nearing a risk window and nearing the upper tier of resistance. So even if it doesn't fall apart on June the 13th, or if it doesn't start falling apart on June the 20th, doesn't really make a difference, because the point is you shouldn't be focusing on the long side. You're focusing on looking for selling opportunities near the upper end of the risk window. Now, for those traders that have trading systems, I encourage you to see how your trading systems that give short signals as we enter the risk window, and especially closer to the upper ends of it, tend to work better. What you will see over time, and I've looked at a lot of different types of trading systems, and regardless of what type of system there is, if you enter one of these windows, you tend to get better trend activity, better volatility potential for trades that will help make mediocre, even mediocre trading systems into something that is much more beneficial. Now, I'm not saying that everybody that uses a trading system is just going to automatically make money because you're in a risk window. You have to have your stops in place. You have to be proactive. But if you're using a strategy that has a mathematical edge, what I have seen is that mathematical edge would be increased dramatically when you're up against the confluence of time and price of that risk window. And that's exactly where we were earlier this morning when the market made a high and it got right into that area. And we put alerts out at the close on Friday that we did not like this market. I even got a call from one of the marketers that I'm actually working with, that basically was asking the question over the weekend, oh, the S&P is just gapped up. Is it, is there any signs that it's likely to reverse? Is it threatening any of the levels? And my response was, well, this is to be expected. I mean, just before a market turning point, you would expect that market activity can, retrace into these critical levels. And the whole point of why these levels are critical is because the action coming off of these points are very dramatic, as we could see today. And a lot of the equities which we alerted of in the prior weeks, like Google, which is a big component of the NASDAQ 100, is really selling off hard today. And it's one of the worst performing stocks going forward that we see with our risk maps that are definitely that in our estimation is going to severely impact the technology sector. Now I'd like to go take a look at the S&P index. So I'm going to go to the S&P 500 index, the cash market, And you can see it's down about 12 points today, and we've been in a steady slide since the April period. And what you will see here, I'm going to zoom in, similar to NASDAQ, is that, again, we're butting up against the top of a risk window. And actually, I'm just going to draw the window right here. It actually extends right into next year, okay, again into the May period. Now, the upper end of the window in the S&P, okay, happens to be around like the 1354 to 1365 area. Okay, the long term, real long term is 1380. But relevant is really, it's climbing the wall of worry along this purple boundary. And this is natural retracements, okay? Like over here, when the market got underneath the white boundary to go to the next level, which was the purple boundary, which it did it in waves. It came down close to it, rallied up, and then went through it. Until the market gets through one of these critical levels, the prior level becomes the resistance point, okay? So right over here, we got underneath this purple boundary. So the purple boundary and this teal boundary becomes a resistance point. And the upper level of that boundary right now, you know, going into July, happens to be the 1355 area. And you can see what's happened is that this short covering rally that happened, we had that big run up one day, and then the market's fighting and climbing the wall of worry along this purple and green teal boundary. And you could see the upper level of the wicks of these candlesticks. If I zoom in over here, there's the upper end of the wick, so that's the high of the range, and then it failed. So it got into the purple boundary and then failed, and got in and didn't even. So even though the market may have gone a bit higher each day, and you may hear it in the news as, oh, the market is stringing together a few up days, it really means nothing, because you really got to look at the relative activity of the market compared to how high that market could go inside the risk window. And you could see here, there's not too much higher it could actually go on a per day basis, because this resistance point crawls up very slowly on a daily basis. And we all know what happens. If the market can't take out a previous high, the market usually goes the other way. And if it keeps on challenging that point, and as this map shows, it's going to be hard to challenge it because there's more and more of these boundaries in the way as we progress into this period. It's just basically going to form a consolidation, build up energy for the next leg down. And as I've indicated many times in past discussions, any one of these boundary conditions that you see on this map, whenever they start sloping up and prices fall into those points, that acts as no support level. So yes, it's true over here when the market kind of pushed up, there was support along these downward boundaries. But what's happening is as the market's rallying up and consolidating over here, all these boundaries are starting to flatten out. And when price gets underneath these, that's when you get the acceleration down to the next level. And unfortunately, the next level on the S&P is the 1230 to 1199 area, and potentially on a spike between 1140 and 1170. So that is what we have to look forward to, okay? And that would be you could see where this major boundary is sloped down, and it's kind of sloped down into December. So this is probably going to be an area of support for the remainder of the year. But if for whatever reason a news event comes out and we do get underneath, let's say we do get underneath 1084 after we get down to that next major level, this summer of that 1140 to 1170, yeah, then there's no saying to how low you could go, because nothing here is sloped down, except for maybe just a bit of that component. That could take you down to 737. I don't think those kind of levels are going to be hit until next year, okay? But at this point, it's bad enough to get a move down back into the, towards the 1170 to 1,000 area, and that certainly would be would probably represent big problems throughout the market. So what I'd like to also talk about is the XLF. I always like looking at the financial sector to give me an idea when weakness is coming into the financial markets. And I noticed on Friday, financial companies, even like in Canada, like Bank of Nova Scotia, underperformed. Market went up, it went down. And that is not a healthy behavior. And I've noticed lately that the Canadian banks look like they could be the ones under the biggest gun of pressure, especially Bank of Nova Scotia, stock, and TD. But Bank of Nova Scotia is the one that I really think people need to eye. I don't think there's any systemic problem, like outside of a market crash in the stock market point of view. Yes, there'll be a fundamental reason why that stock is crashing, but it's not like a solvency problem that can't be corrected by government intervention or some kind of action by the banks. Okay, and I do think this is going to be this crisis is going to hit the banks due to a North American real estate bubble. And don't forget, the bubble in Canada is about 40% higher than the bubble was at the peak of the U.S. Top. So I would expect similar or worse action in Canada over the coming years, and I think it's going to kick off starting this year and at the latest early next year. And I think Bank of Nova Scotia is going to be severely impacted by that in a big way due to the mortgages that were created. And you can see here on the XLF, it had its rally. It had a bit of a rally, but again, it failed into this purple and teal boundary, and the next level down happens to be below $12, which is very, very severe, considering that there's a nonlinear impact between the XLF and the S&P. When the XLF falls a certain amount, the S&P falls multiples of that amount. So, a 10 to 20% decline in this index could really spell trouble for the overall markets and structural cracks in the system. I just want to take you to a chart of the REIT index for North America. Okay, it's North American Real Estate Investment Trust Index. The symbol is IFNA. Okay, we've talked about it in the previous weeks, and I've kind of marked up this chart, so bear with me here while I zoom in. And what you will see here is that, again, just like the S&P and the NASDAQ, market came down, bounced, came down, bounced. Each bounce, even if the bounce, sometimes the bounce could go higher. A lot of people say in technical analysis that, oh, well, if you want to be stringing together, points where, if you have lower highs and lower lows, that means the trend's going to continue down. And if you tend to take out a previous high point, even if it's a local high, it tends to give credence that maybe the market is neutralizing. That is nonsense. That is absolute nonsense, because when a downtrend of any significance materializes, it tries to trick the largest number of traders into thinking the exactly wrong thing at the wrong time. And time again this happens. And the best way to make it happen is for price to actually come up and just take out a previous pivot point by a tick and then completely reverse. In this specific case, it hasn't yet. Does it mean that it couldn't have? Sure, but there's so much resistance in this area over here that even if the market took out this previous pivot, it wouldn't mean anything about a bull market. It would just be building more energy to trick a whole bunch of those players and then reverse the market. As I indicated in the previous map, any of these lower boundaries that are sloped down act as support. But you can see here, as this market is consolidating and building more root cause or energy to break down, you can see these boundaries in the future are starting to curl up and get sloped up, which means there's no support when price gets underneath them. And if I take a look at that date is like, in the July period. After like July 5th, and especially, as you get into the middle of the month, if you take out those levels, and that level, if you, trade underneath 43.36, it's not a matter of us having to wait for that. I'm just saying there's going to be a dramatic acceleration in downside activity. And if there are retracements in the market, the retracements are going to be limited. The limiting potential of the rallies is worse and worse as you get through critical support in the context of this framework. So you're going to be like limited to like the 45.39 area to the 44.33 area if we actually get a full day underneath 43.37, especially in July. When that happens, you're opening up a gap to here, and then after there, a gap down to the 36.24 area. That's a huge move on an index, that has been relatively very non-volatile and in a consolidation for an extended period, and then immediately to see a move like that. That would be, that would take you all the way back in a very short period of time to where you were last October, when things, when there was definitely problems in the market, okay? Except now there's a lot more, hot money in the system, And I have to say that Canada and the Canadian banks should be on high alert for the bubble to be popping. Okay, and I would pay very close attention to the IFNA index, whether you trade it or not. I don't look at this to trade it. I look at these to give me the intelligence that something is wrong in the financial marketplace today. Okay, I also like to take a look at the chart of gold. I've got many people asking me what's going on with gold, and you know what? Over the past number of months, I've been telling people over and over again, and on our weekly webinars and our live webinar briefings, don't expect much from gold. It's going to be much to do about nothing. It's going nowhere. It's going up. It's going down. It's building cause to do something when ultimately, currencies around the world crumble due to the government intervention that really isn't proper, and the limits of debt. There's a limit to how much debt you could have, and eventually systems crumble, and then you have citizens fleeing into gold. But you also have to remember there's a competing factor. Until that happens, because everything is priced in. Excuse me for that loud noise. That is the end of the day in the market. Okay. So, anyways, as you can see here, the market is closing on its lows. Nasdaq down close to 50 points. The Dow cash market down 143 and a half. So definitely things are taking a turn for the worse. Also, it's an outside day today in terms of candlestick theory. Not that I really care about candlesticks, but there are people that look at it. What happened is that we happen to have a situation where the market actually ran up to a higher high intraday and then ran down and closed lower than the previous day, and actually probably the previous 2 days, especially in the Nasdaq. That's extremely bearish from a candlestick point of view, and certainly from our in this specific situation, that candlestick concept is likely to work just because we happen to be in a risk window. And as I said, any trading system that tends to have some credence over time will tend to have even more credence inside of risk windows and amplify the effects, okay, of what they represent. So in this case, an outside bar closing to the downside and a key reversal bar would indicate bearish activity and any rallies to be faded, okay, and lower lows in the horizon for the market. That's what we see. So in terms of gold, like right now we happen to be in a situation where part of the reason why the market had a bit of a retracement is because everything's priced in U.S. dollars, and the U.S. dollar had a bit of a rally. Excuse me, a bit of a sell-off from the recent rally. And when the U.S. dollar gets depressed, it requires more U.S. dollars to buy the goods. So if everything's priced in dollars, then the valuations go up. But it doesn't mean the real value of what you're buying is going up. So it doesn't mean the market is actually healthy. Okay? Only when the U.S. dollar goes up during a time of GDP growth. And there isn't GDP growth, because if there was, you wouldn't have the long bond having such low rates. Low rates indicate low GDP growth. Now, I do realize a bit of that is being camouflaged by the fact that the government has some intervention where they're purposely pounding the interest rate curve downward. Okay, so they're making rates low, but even without that, they're still exceptionally low yields, indicating low GDP growth. And when the U.S. dollar rises in an environment of low GDP growth, that is bearish for the market. So just remember that. It doesn't mean there's a demand for America because the dollar's going up. It means there's a restriction in the flow, in the amount of dollars available, meaning that there's a deleveraging process taking place in the banking system today where people are hoarding their capital. And part of the reason why not just the United States is hoarding capital, but also a lot of the European banks are, is because they've got these agreements in place, or these facilities in place with the ECB and other central banks that are basically giving them free money. And and they could earn interest and take it somewhere else. Why should they loan it out and put it at risk in an environment of deflating GDP growth? where they could actually end up getting themselves into trouble. They might as well just take advantage of the situation. I'm not advocating that, but that's exactly what they're doing, and I think it's getting us into a bigger problem down the line, because eventually there's not going to be an infinite line, a money line that's going to be provided by the ECB or other central banks, especially once the public sees that at the end of the day, who's this, all this market stress, who's it really falling on? It's falling on the average citizen and the taxpayer, okay, to pay for the profits of these large enterprises that are not allowing the economy to grow properly because they are not acting in the way they were designed to act, and that is to lend money out, especially when provided to you at very low rates by central banks. So I think this is something that's going to come to realization as the year unfolds, and I do highly trust what this risk map is telling me, and it's telling me in a very big way that there is a crisis of confidence and a wave of uncertainty that is going to hit the markets en masse, and we will be in for a rude awakening right into May of next year. Now, in terms of gold, and I'd like to go back to gold over here, I've been saying that gold itself, I've been bearish on gold since way back over here, and gold has been coming down. Now, at this point, yes, it's at a level where there's a lot of boundaries that are sloped down, acting as support. Okay, so I do have to say that there's a lot of support, like at the 1499 level, and there's a lot of resistance into the 1714 area, and tons of long-term resistance. Between around 1825 and 1766 to 1809 is also your broad trading range. For those gold bulls that think gold's going, to 3,000 or 2,200, yeah, I do think that could happen down the line. It just is nothing like that is really going to happen unless you actually, get a rally up to here, then you get a rally back down. It's going to take a long time, okay? And so long as the U.S. dollar has a potential to rise dramatically during the deleveraging process, gold is going to have a headwind. Okay. At the same time, because there's a crisis of confidence in Europe, there's also going to be the component of gold that tends to do well based on uncertainty in the world. But if you have to weigh uncertainty with deleveraging is a pretty there's a lot to deleverage in the world today, and that could be the thing that actually holds back this rally for an extended period. Now, basically, but I'm not saying, I will update you if I see a mass consolidation. Let's say we get a rally up over here. Let's say you get a rally to 1700 or 1685, and then it comes back down, and then it breaks out, and we happen to have all these boundaries sloped down. Yeah, then you could get a nice rally, into 1875. But to really get a dramatic move into north of 2000 and much higher, you really have to constructively build some kind of a base going into April of next year, and then take out those highs of 1900, clear that, and then then at that point all these boundaries are sloped down, and then you've got long-term support at 1600, at 1680. And then you don't have to worry as a long-term investor. You look at buying the dips and just keep on doing that. But right now, yeah, we're at kind of in no man's land in gold. But you got to be wary, because if this market just kind of glides along here and doesn't make any major headway, and now everything flattens out again, and let's say come later in the year you break below this critical area of let's say that critical area being say 1495 to let's say around 1495, you get underneath there, then you've got risk all the way back down to 1160 to 1200 on gold. Now, it doesn't mean it's the end of the gold bull market, because gold has had a nice big run up, and there's tons of support down above 1,000. But for those people that think that it's immediately going to 2,000, it's not immediately going to 2,000. It's in a wide trading range, so it's a trader's market. And traders could take advantage of that, okay? But I just think that there's more opportunity in markets like currencies today, trading the U.S. Australian dollar, or looking at the euro currency, or trading on the short side on the U.S. markets, or or trying to profit from the housing bubble, or banks that are going to implode due to the housing bubble. Those opportunities offer much more clarity and much more a higher ability to take advantage of the difference between what people perceive and what is actually going to happen. Because right now, there tends, in the gold market, it's all over the place. There's not such a huge divergence between what's going to happen and what people think is going to happen. Where in the stock market, you've got some people thinking it's going to the moon, and other people thinking that it's going a little bit lower. Not too many people thinking that it's completely, falling apart in the U.S. A lot of people think a lot of the big problems are overseas, and the U.S. is buffeted by those forces. And even Canada, recently, there's been a lot of articles saying that we've got the best banks in the world, and that may be the case. But the best companies in the world have nothing to do with the best stocks in the world. And at the end of the day, a stock is a piece of paper, and a piece of paper is only worth what the supply and demand line of traders and investors are willing to pay. And in a deleveraging process, people will be willing to sell whatever they need to cover their debt and financial obligations. And I do believe we're entering into the final chapter of a deleveraging process that will hit really hard and to the core of the North American public. And it is also affecting overseas. It's not just in Europe, but it's also affecting Singapore, and it's been affecting Hong Kong, and we were, the first to talk about it well before Hong Kong started rolling over. So I really encourage the listeners, and I'm just going to go over here to our website, to actually fill out their name and email at the top of our website and register for the market briefings. So that pretty much concludes the market briefing for June the 11th and ending at 4:10 p.m. I encourage all of you to join us next week. We either issue it on Sunday evening or Monday morning or afternoon, depending on the available information at the time and what is necessary in order for us to give you the best analysis for the upcoming week and month. Thank you very much for joining us here today, and look forward to giving you some insight for next week. Thank you.